And why isn't the rupee recovering? In fact, it's a new low today. For all this and related questions, I have with me two top-notch economists, Shantanu Sengupta, the Chief India Economist at Goldman Sachs, and Madhavi Arora, the economist from Emkay Global. Madhavi, Shantanu, thank you very much for joining us. Shantanu, what were the key takeaways from the export numbers? Did you take away something very positive in that, we are doing well despite tariffs?
Yeah, thanks, Latha. I think, you mentioned too, I think the third point I would mention apart from better exports to the US and lower gold imports is the diversification of shipments outside the US for particularly labor-intensive exports like textiles and gems and jewelry. Overall, the number has beaten market expectations. I think the market was expecting somewhere around $30 billion. It came in at around 25. We think the peak current account deficit is in this quarter. It'll improve from the next quarter. So the current account stress, particularly on the rupee, we think largely would be behind us. There are other things which are impacting the rupee, which we can get into later on, but the current account stress is likely behind us now as we head into 2026.
But are you changing your current account deficit number? Are you having a downward bias to the current number?
We already had a sub 1% number. I mean, it can tweak around by maybe 10 basis points, but in any case, it wasn't really the piece which was moving the needle so much. Apart from the fact that all of that happened in the second half of the calendar year. I mean, last quarter and this quarter, the current account widened. But on an aggregate basis, it still looks quite manageable. But it's just that it all came together during Q3 and Q4, which is why you had that exaggerated move in the rupee.
No, I take your point that the current account, even if it is 1.3, 1.4, is not a big deal. We have lived with 2% plus for a very long time. It's just that even that minor deficit is not getting filled up by capital flows. Madhavi, your thoughts. What are your key takeaways from the November data? And are you likely to lower your current account deficit number?
Hi, Latha. So clearly the way things are moving, it's getting extremely difficult to really catch the trend. The trade numbers have been very volatile. Nobody expected it to be sub 30 billion. And here we are, right? So I think one has to reckon the fact that there's been, I think across Asia, it's not just India. If you see Asia exports as well have done extremely well, possibly largely led by tech. But for India also, if you look at the, diversification we have done in our tariff-led exports, especially, segments like gems and jewelry, textiles, they actually have been pretty, they've not, YTD have not seen a massive growth, but have been largely flat. There's not been a negative growth. Have found new markets, especially sectors like marine products. They've actually seen 15% growth on the back of higher shipment to China. We also see in the rest of the world growth actually being much more resilient and actually, increasing their share in the last 3 months. So it's a quite, encouraging trend in terms of both resilience as well as diversification or shipments or whatever one would like to say. I think it's not just India, it's actually Asia, which is again...
So then it is a sustainable trend?
Led noises very well.
So Madhavi, would you therefore say it is sustainable?
Well, I have to really see that because honestly speaking, last month we were so bearish on the trade that we were discussing whether this month could also probably be touching a 30 billion plus number and what it would imply for the current account or BOP. As we stand today, the 4-month low deficit of trade again is making us, think about the trends that we may see in the export sector. My sense is that businesses are very smart in the end, right? Across the world, they would want to adapt to the new global order. So I'm not sure whether it will be sustainable. I'm sure, but there'll be a way to weather out these noises. Even if we are seeing some volatility in trade numbers in India or in Asia, I think on a more smoothened basis, I am very sure that businesses will be able to weather this noise.
Shantanu, can we make the statement that therefore the US tariffs don't matter as far as the Indian external sector is concerned? We have learned to weather it.
I think it does matter. If tariffs were not there, current account would be slightly lower. But I think what's happening right now is that you have a confluence of the current account widening lower capital inflows, likely partly because of the US tariffs being imposed. And you're having to fight a pretty large short forward book, which you are running down. All of that put together, along with INR valuation, if you look at it from a real effective exchange rate that is inflation adjusted basis against your trading partners, it was quite expensive at the beginning of this year or around this time last year, after you had held the rupee almost in a very, very low ball range. So you are adjusting in terms of valuation on the currency. Ultimately, the currency is reflective of prices, right? So you're adjusting in terms of valuation in the exchange rate. And it's the right time to do it because your inflation, in any case, was running at near 0%. I mean, you've 0.7% inflation now, you're likely going to go up to about 1.5% inflation in December. So if you wanted to make a currency adjustment, this is an opportune time because the inflation pass-through from weaker exchange rates is going to be pretty manageable for the macroeconomy.
Fair enough. Fair enough. That's exactly what the chief economic advisor said, that this is the best time to let the currency adjust because it's not going to impact inflation. But the reason why I asked you about US tariffs not being a major deal is that there is a general feeling in the stock markets that if the US deal is signed, then the rupee will not be under pressure. Now we can't hope that because, I mean, can we say that? That in case, say, the US deal is signed in a month or two, does that really remove the pressure from the rupee?
So the short...
No, Shantanu, let Shantanu finish that, yeah.
The short forward book position doesn't go away whether or not you sign the US.
But the short forward book can be rolled over, isn't it? I mean, we've seen RBI do this in the past.
It depends a little bit on the size. So if you central banks may not feel comfortable at $70 or $80 billion of short forward, may feel more comfortable rolling over at $40 or $50 billion of short forward. But what goes away once the deal is signed is the uncertainty that you have on likely private capex, also the MSME sector. It's a surprise that we have seen on the textiles and the gems and jewelry front. But at the same time, you would have seen some fiscal ammunition being directed towards those sectors, right, in terms of credit guarantees and so forth. So yeah, I mean, it's still a headwind for the economy. And once that is lifted, you will likely have slightly better growth and slightly lower current account purely from the export front.
Okay. Madhavi, let me put that question to you. My own sense is that from the way the rupee reacted to or did not react to the very good trade numbers, my sense is that capital flows are not coming, and it is unrelated to the tariff. The capital flows are not coming because our corporate growth story is not good enough. Our earnings growth story is not good enough. So even if the deal is signed, will capital flows, I mean, will the FPI flows come unless they see earnings growth?
So, Latha, see, trade is always a relative play, right? As I said that while we have been resilient, Asia has actually done better. Their exports are actually booming, which is led by tech exports. And Asia currencies have also done very well, despite the fact that, they also have been imposed with certain tariff. Clearly, we have a penal tariff on us. It's but natural that we will have some implication versus our peers. So we will be differentiated when it comes to, market positioning. As you rightly said, it's no longer a problem of current account, but a problem of capital account, which also has some sense of, I think it's more a positional play as well. It's not just, the sentimental aspect or expectation aspect that, will continue to weaken. I think it's more a positioning play, especially for the month of November and December, where most FPI actually tend to, close and leave emerging markets. So maybe to that extent, India has been disproportionately hit, and clearly so because we are also facing a much higher penal tariff. Once the penal tariff is probably gone, we'll have to see the quality of the trade deal that we actually end up signing with the US. The contour of the deal will be very important. My sense is that at best, you're probably going to just get rid of the penal tariff, and you'll still be at best placed in line with the emerging market peers, which doesn't give you any kind of a big leg up versus them in terms of competitiveness. So that would remain a problem. But at least to some extent, that would take away the uncertainty with regard to India being, very worse off compared to peers, or, a position in a way that, we will end up getting the massive hit as far as the trade dynamics are concerned. But I don't think that would be would be the deal to seal the
I'm
rupee.
told I'm out of time, so I'll have to quickly wind this up. Shantanu, what is your sense about the rupee itself? Where does the decline end? I mean, is it at some... when you speak to FPIs, what do they tell you? It looks like unless the FPI flows turn positive, the rupee is going to be under pressure. What is it you're picking up from FPIs, one, and what is your own forecast for the currency?
Well, from investors, what we are hearing is that they're looking for a catalyst to play India going into 2026. It still remains a strong growth story, and at least tariffs would be one of the headwinds. It may not be the only one, but at least one of the headwinds for the growth story. Look, our sense is that as you head into the next quarter, your current account suddenly will shrink from almost 3% of GDP in this quarter towards near zero. So just the dollar demand will just be so much lower than what you faced in this quarter or even in the previous quarter. So we think you peak out at around $91 plus minus a rupee or so.
Okay.
91 rupee to the dollar plus minus one.
Got it. Madhavi, just your number. I'm sorry, out of time. What's your forecast?
So I'm in line with Shantanu. I also believe that probably you're going to be toppish on 91. Next quarter is going to be healthy as far as the current account is concerned, and most likely you will see new inflows to emerging markets where India will also benefit at least to some extent, and that could lead to some pressure being off the rupee, and we may even see positive news with regard to trade deal, even if it's not a great trade deal.
Sorry. I would be
getting rid of our
time for one
trade. So I think 91 would be what I would also look at, and most likely a range around 89.50 to 91 type.
Okay. Sorry, out of time. I had to rush too many things. Thank you very much, Shantanu and Madhavi. The important point Shantanu is making is that next quarter we will be in a current account surplus, and therefore, the demand for dollars itself will go away, and we should see the rupee, recovering or at least stabilizing. But the big problem is that FPI and FDIs are still pulling out. When will that stop? That's the question to which we're not getting answers. Wrap up on Bazaar.